Hello and welcome back to part 3 of our group accounting installment series. So we are basically going through a series where we are dealing with questions on group accounting, just zoning in on various aspects that students typically find tricky. And so in this video, what we're going to do is we're going to look at intercompany sales of inventory from the parent to the subsidiary, and we're going to look at how we are eliminating that on consolidation. Okay, so in this question, it says at the 1st of Jan X4, Delta acquires 75% of Echo. So we have Delta and they own 75% of Echo. That is a subsidiary company. Okay, and then we are given the at acquisition fair value amounts. The at acquisition value of the net assets. And then we are told there are no fair value adjustments or goodwill impairments. Now, during the prior financial year, Delta began selling inventory to Echo. So Delta is selling inventory. So this is a downstream transaction. And that inventory is being sold for 900,000, but it costs 600,000. So if you think about it, in the prior year, Delta has made a profit essentially of 300,000. That's the profit that Delta has made. And in the current year, they have sold further inventory costing 1 million for 1.4 million. So in the current year, they are making a gross profit of 400,000. At the end of last year, the question tells us that 40% of this inventory was still on hand. And then at the end of the current year, 25% of the inventory is still on hand. So the group is applying the gross profit margin approach. The tax rate is 30%. They're using the full goodwill method, and the fair value of the NCI acquisition is 1 million. So all we have to do is the pro forma consolidation journal entries for 20x5 to eliminate the unrealized profit and account for the deferred tax effects as well. So, something that's not in the required over here, but that you could go and do for yourself, is that you can go and do the pro forma journal entry to eliminate the equity at acquisition. Okay. But we're not going to go through that. We're going to do the elimination of the intercompany inventory. Okay, so when we think about the elimination of intercompany inventory, there's really three things that we need to take into account. The first thing is that you've got to think about what are the sales that are currently being recognized from a group perspective. Okay, so when we think about the sales, remember that in our starting point, the parent, which is Delta, would have recognized the sales that they have made to the subsidiary, which is Echo. But those sales should not be recognized because they are intercompany. And it is only when Echo goes and sells those to a third party that the sales income can actually be recognized from a group perspective. Okay, so that's the first thing to understand, that there are intercompany sales here that have to be eliminated. The other thing is that at the end of the year, okay, if there is still inventory on hand in Echo's books, that inventory is essentially inflated because Echo has purchased that from Delta, and sitting in that inventory is a gross profit. And that gross profit we cannot realize at a group level because the inventory is still sitting within the group. So that gross profit does have to be eliminated. Now think about why the gross profit is there, because when we calculate our cost of sales being our opening balance plus our purchases minus our closing balance, to the extent that we have inventory in our opening balance and inventory in our closing balance that has this markup, this is impacting our cost of sales, which then has an impact on our profit ultimately. Okay, so what are we going to have to do in terms of the elimination? So if we just think about eliminating the sales, right? So I'm going to start with 20x5 and then I will look at 20x4. Okay, so if we think about 20x5, Delta has made sales of 1.4 million. that they have sold to Echo. So that entire 1.4 million has to be eliminated. So we would then debit our sales because it's sitting in the starting point for Delta of 1.4 million. Now, the credit over there that we're going to eliminate this again would be, well, if you think about it from the perspective of Echo, when Echo sells all of this inventory, then they are going to recognize that 1.4 million as the cost of sales effectively, right? Because that is the cost that they paid when they acquired it from Echo. So in our starting point, our cost of sales then would be overstated. And so we need to eliminate that against the cost of sales. Now, the question is asking us to also take into account the deferred tax consequences. And so the question then arises, do we have deferred tax consequences from this adjustment over here? Okay, well, if you think about the net effect of this adjustment, right, we are decreasing our profit or loss because of the sales over there, because we're debiting the profit or loss, but then we go and credit the profit or loss for the cost of sales being overstated. So the net effect on our profit, okay, is null. And if the net effect on our profit is null, then we expect that the net effect on our tax should be null as well. Because if profit is not changing, then my tax is not changing. And so there should be no deferred tax related to this journal entry over here because I haven't impacted group profit at all. Okay. Now, if we think about last year, where they would have had sales, Delta would have recognized sales of 900,000, and then Echo would have recognized costs of sales of that 900,000, right? Would we go and process a journal entry to eliminate that? Well, no, we don't need to, right? Because last year's sales, where would that have been closed off to? That would have been closed off to retained earnings, and last year's cost of sales would have been closed off to retained earnings. So effectively what we would be doing, we would be debiting and crediting retained earnings for exactly the same amount. So there is no need to go and process that journal entry. And then the related tax, exactly, it works out the same as we said with this year. So that's our first journal entry where we are eliminating the actual intercompany sale. Now we've got to think about the unrealized profit. So let's first think about the profit on hand the unrealized profit for 2005. So we are told that 25% of inventory is still on hand at the reporting date. So let's see. If you think about this from the perspective of Delta, so what is the gross profit that Delta has recognized? Delta has sold this inventory for 1.4 million, and the cost that they have is 1 million, and so they would have recognized a gross profit of 400,000 that is sitting in that inventory, right? But at the reporting date of this, 25% of the inventory is on hand. So we would take 25% of that 400,000, and we would say that included in the inventory that is sitting in Echo in my starting point is this gross profit over there of 100,000. And so we need to eliminate that effectively. Now, I want you to think about the cost of sales formula. Okay, so think about this cost of sales formula over here. Okay, let's color that over there like that. Okay, so if we have this 100,000 that's sitting in my closing balance over there, okay, so think about what is happening. My closing balance of inventory is effectively overstated, and so in order for me to correct that, what do I need to do? I am going to need to credit my inventory. Okay, so I'm going to credit my inventory by 100 to eliminate that and bring my inventory to the correct cost for the group. Okay, but what is the contra to that? So that inventory, which is in the closing balance, right, is overstated by 100,000. So when I'm determining my cost of sales, I am subtracting my closing balance, right, and I am subtracting an additional 100,000. Right, so this is going to mean that my cost of sales ends up being smaller than what it should be. And if my cost of sales is smaller than what it should be, then ultimately that's going to have an impact on my profit. So what do I need to do in order to eliminate that? I need to increase my cost of sales, and the way that I do that is by debiting cost of sales 100,000. Now that I've eliminated the profit, the unrealized profit that's sitting there, I've got to think about what are the tax consequences. Okay, so here I am debiting profit or loss, and here I am, of course, crediting the statement of financial position. So if we just zone in on this credit over here, think about what's happening. This 100,000, what am I doing? I am impacting the carrying amount. So the carrying amount of my asset is being decreased, which means my temporary difference is effectively being decreased. Okay, and so because the temporary difference is decreasing, I know there is going to be a movement in my deferred tax. But remember, if you recall from the first video in our series, I said that when we are dealing with deferred tax in a group setting, it's easier to think about it from an income statement perspective, or sorry, from profit or loss. So if we look at this cost of sales adjustment over here, right, what is it doing? It is increasing cost of sales by 100,000. So if cost of sales goes up by 100,000, then what's going to happen to profit? My profit is going to go down by 100,000. And if profit is going down, then I would expect my tax to go down as well. And so my tax then would be decreasing because of this decrease in my profit. So the tax rate that we are told we are dealing with here is 30%. Okay, so I am going to take that 100K and multiply it by 30% to give me 30,000. Okay, so that is the adjustment on my tax. And so in order to decrease the tax expense, what must I do? I must credit my deferred tax in profit or loss by 30,000, and then I would debit my deferred tax, okay, by 30,000, and that is in the statement of financial position. Okay. So those are the tax consequences over there. And then the third thing I've got to, or the third journal entry I then need to consider would be the impact on the opening balance. Now, remember that last year's closing balance of inventory becomes this year's opening balance of inventory. And so last year we had this unrealized profit of we had this gross profit of 300,000, but 40% of this, right, is on hand at the reporting date, right, at the end of last year, because it is sitting in my inventory balance. And so 40% of that, right, 40% of that is 120,000. Okay, so if you think about it, if I think about my cost of sales calculation, my opening balance over here includes 120,000, right, of unrealized profit that is overstating my inventory. So if my opening balance is going up by 120, then it means my cost of sales is going up by 120 as well. My cost of sales is overstated. So what do I need to do? I need to bring that down. And so in order to bring that down, I have to credit my cost of sales by that difference, and that is 120,000. Okay, so I had a bit of a technology fail at this point. My microphone died, and so I'm just going to have to voice over this. So what I'm going to say is not necessarily going to line up with the video, but I mean, it is what it is at this point. It's late. I have to get through this. Okay, so we have basically we understand now where the credit is. It's going to the cost of sales because that is the opening balance, and that opening balance is overstated. But what about the debit? So if you think about the fact that the cost of sales this year is overstated because of the opening balance, remember that the opening balance was last year's closing balance, and so last year's closing balance was overstated, which would have made my cost of sales understated because I'm subtracting such a big number. And if my cost of sales is understated, then that means that the retained earnings that are recognized in the previous year must have been overstated. Okay, and so I then have to eliminate that and bring that retained earnings back down by the difference, which is the unrealized profit. And then again, the question becomes, what are going to be the deferred tax consequences? So if we think about the current year and we think about what we've done with the cost of sales, where we've credited profit or loss, what has happened to profit? So for our profit, if you think about it, if we're crediting profit, if we're crediting our cost of sales, then that means our profit must be going up. And so if my profit is going up, it means my tax is also going up. So if my tax is going up, then I know I am going to have to debit my tax expense in profit or loss. So I'm going to debit my deferred tax. Okay, and it's going to be 30% of the 120,000. Okay, then when we think about the impact of the retained earnings, so the retained earnings is telling us that last year my profit was effectively understated, right? And this journal entry is bringing that profit down. So essentially bringing my prior profits down, and that means that I expect my tax to go down as well. And so if my tax goes down, then that means I would have to go and credit my retained earnings, because then if my tax is decreasing, my retained earnings is effectively getting bigger, and so I'm crediting retained earnings by 36,000. And so just in terms of bringing this video to a close, I think the two things I want you to think about. The key here is that you've got to think about what is happening with cost of sales, opening balance, closing balance, and how that relates to profit. And if profit changes, then tax, of course, is going to follow. And then also, I want you to understand that this is a downstream transaction where the parent is selling to the subsidiary. But if it were the other way around, then there are going to be some implications for the non-controlling interest. And so if that is something you would like me to discuss in a future video, then you can drop a comment down below, and I will put that on my list of videos to do next. Okay, so I'm hoping to obviously continue the series. We're going to keep going, but I would like to hear from you. So if you could tell me what are the aspects of groups that you're most struggling with, and then I know what I need to talk about next. So I look forward to seeing you in the next video, and yeah, I will see you next time. Bye.